The stock market, a place of endless opportunity or a ticking time bomb? Today we're going to be diving into the S&P 500, which is often seen as the heartbeat of the US economy. But is it stronger than ever, or are we standing on the edge of a cliff? Let's break it down. So the S&P 500 is an index made up of 500 of America's largest companies. Think of it as a snapshot of how the US economy is doing. But here's the kicker. Not all of the companies in the S&P 500 are created equal. Some are actually more influential than others. And right now, the top 15 companies in the S&P 500 make up over 41% of the index. Let that sink in. Just 15 companies out of 500 hold that much weight. 8 of these are tech giants, and the top 5 alone are some of the biggest names out there, including Nvidia, now 7.22% weighted, Apple 6.93% weighted, Microsoft 6.2% weighted, and so on and so forth. In fact, the top 50 stocks in the S&P 500 account for more than half of the entire index. And if you've ever compared the regular S&P 500 with something like the Invesco S&P 500 Top 50 ETF, you'll notice they perform almost the same. That's how much power is concentrated at the top. Now you might be wondering, why does this matter? Here's the deal. When a few companies dominate, the performance of the market depends heavily on them. If they do well, great. But if they stumble, yeah. It also means the S&P 500 isn't as diversified as it seems. Even though it's made up of 500 companies, it's really just the performance of a handful of giants that drives the whole entire thing. So, is this something to worry about? Well, in my opinion, it does depend on a few factors. On one hand, these companies are dominating for a reason. They're innovative, profitable, and leaders in their fields. Tech, for example, has transformed how we live and work, which explains why these companies hold so much weight. But on the flip side, concentration also increases risk. Think about it like this. If your entire portfolio is just a few stocks, a bad day for one of them could be devastating. That's essentially what's happening in the S&P 500. A stumble in just a few of the big names could drag the entire index down. Let's also throw something else into the mix, a fun word for us all: politics. Donald Trump is returning to the presidency, and some of his policies could shake things up. He's been very vocal about deregulation, deglobalization, which could boost US companies by reducing the red tape and focusing more on domestic production. Big plus. But there's always a flip side. Deglobalization might actually lead to higher costs, and deregulation, well, we all know how that can lead to unintended consequences, i.e. 2008 financial crisis. It's hard to say if any of these policies would be a win or a loss for the market, but they could certainly bring volatility. So where does this leave us? The S&P 500 is an amazing tool for tracking the market, but don't let its 500 company roster fool you. Its fate is tied to a few of the major players, especially in tech. As an investor, it's worth keeping an eye on concentration risk and thinking about what policies from Trump or anyone else could mean for the future of these big companies. The market is always one step away from disaster, but also one step away from big opportunity. So stay informed, stay curious. Let me know in the comments, are you bullish or bearish the S&P 500 going into 2025?